Okay, let's just dive right into this explainer and completely demystify flexible budgeting and profit reconciliation. If you've ever looked at a company's end-of-month financials and thought, wait, why doesn't the actual profit in the bank match our original plan at all? Well, you're in the exact right place. Today, we're going to unlock exactly how management accountants solve that mystery, and we'll use some real-world business scenarios to do it.
To keep things moving, here is our quick roadmap for today. First, we'll look at the fixed budget trap. Second, building a flexed budget. Third, the impact of profit variances. And fourth, a step-by-step profit reconciliation.
All right, part 1, the fixed budget trap. Let's start by looking at a huge problem businesses run into at the end of a period.
So why do fixed budgets completely fall apart when activity levels change? Well, think about it. Imagine you plan to produce 1,000 units of a product, right? But suddenly, demand skyrockets, and you end up producing 1,200 units. If you take those new, much higher actual costs and compare them against your rigid fixed budget, it's going to look terrible. It'll look like you grossly overspent, but actually, scratch that. You didn't overspend, you just produced more.
The contrast is pretty wild. Trying to use a fixed budget to judge performance after your volumes have shifted is basically useless. It's comparing apples to oranges. A flex budget, on the other hand, is a brilliant tool prepared at the end of the period. It actually adapts. It recognizes cost behavior patterns and shifts right alongside your volume of activity.
Which brings us to Section 2, building a flex budget. The big question is, how do we actually build this thing so we are comparing apples to apples?
The whole idea of flexing is continuously adjusting your expectations to match reality. You're updating your budget allowances based on the exact actual number of units or liters you produced. It's absolutely crucial because it's the only way managers can ensure their variance comparisons are grounded in reality, rather than a wild guess made months ago.
Now, the golden rules for calculating this are super simple. First, your fixed costs stay exactly the same. I mean, your rent doesn't magically go up just because you manufactured one extra unit, right? But step 2, your variable costs are mathematically scaled to match your actual activity. You just take the budgeted cost, divide it by the budgeted activity level, and multiply that by your actual activity. Simple as that.
Let's look at a real-world scenario to make this concrete. Say your original budget was built for 4,000 liters, but you actually produced 5,000 liters. Your actual volume is 25% higher, so we absolutely have to flex those variable allowances. Take direct materials. The original $36,000 expectation has to be flexed up to a new baseline of $45,000. But look closely at the fixed overheads. They were budgeted at $89,000 and they stay right there as the baseline. They do not scale.
Okay, moving right along to Section 3, impact of profit variances. Let's see what happens once our budget is properly flexed.
Simply put, whenever your actual performance differs from your newly flexed budget, you generate a variance. And that variance either boosts or damages your bottom line. If actual costs are lower than your flexed allowance or revenues are higher, we call that favorable, with an F, and it pumps up your profit. If costs run too high, well, that's an adverse variance, an A, and it directly eats into your margins.
Let's look at James Marshall Ltd. for a great example of how this plays out on the floor. To make 1,000 units, they should have used 2,000 kilograms of material, but they actually used 2,200. Now, breaking down the math, they actually saved money on the material price itself, paying less than the expected $10 a kilo, which gave them a nice $1,100 favorable price variance. Awesome, right? Well, not quite. Because they inefficiently used 200 extra kilograms of material, it created a massive $2,000 adverse usage variance. So in reality, a purchasing manager probably bought cheaper, lower quality materials to save a buck, but it caused a huge amount of waste on the production line.
And these variances, they add up fast. In one of our source examples, a company achieved a staggering $13,650 favorable sales price variance, almost 14 grand, just by charging a slightly different price than expected and multiplying that across 19,500 units. That money drops directly to the bottom line, totally independent of the sales volume.
Finally, part 4, step-by-step profit reconciliation. This is where we prove our math works and soothe all those accounting headaches.
This right here is the ultimate bridge. The core rule of the reconciliation statement is taking your original budgeted profit, adding your favorable wins, and subtracting your adverse losses to exactly match your actual bank account. It connects the fantasy of the original budget to the reality of the end of the year.
Let's walk through this step by step. We start with a base budgeted contribution of $43,900. Next, we stack up our wins. Combined material variances gave us a positive $4,186, and efficient variable overhead spending added $1,216. Then, unfortunately, we have to drain our losses. Selling at lower prices and volumes cost us $4,200, and poor labor rate and efficiency drained another $1,602. And if we do the math, taking that base and adding and subtracting those variances, we land precisely on $43,500. It perfectly reconciles. The difference between our expected $43,900 and our actual $43,500 wasn't just some mysterious missing money. It was the exact calculated sum of every operational win and loss across materials, labor, overhead, and sales.
When you stop comparing actuals to rigid fixed budgets and start actually flexing your allowances, every single operational secret comes to light. Thank you so much for joining me on this explainer. I'll leave you with this thought. If your actual profit unexpectedly drops next month despite record sales, do you now know exactly which variance caused the leak?